Hey guys, here's a summary of reading price charts bar by bar, the technical analysis of price action for the serious trader. Written by Al Brooks, Chapter 1, Price Action. The way I've set up this slideshow is these are the sections within the chapters, and each section will have its own summary with examples. So table of context, trend bars and doji bars, bar basics, signal bars, entry bars, setups and candle patterns, signal bars, reversal bars, signal bars, other types, outside bars. The importance of the close of the bar, exchange traded ETFs and inverse charts, second entries, and late and missed entries. Trend bars and doji bars. There are two types of bars, trend bars and doji bars. A trend bar is one bar controlled by the bulls or the bears. It has a large body with minimal tails. These bars are trends on smaller time frames. They start on the high or the low and move to the extreme with a strong close. A doji is a range bar that is neutral. It usually has a one-tick body and a long tail on both sides. This shows the market traded at both ends and closed in the middle. Bars with more tail than body should be considered dojis. Here's an example of trend bars for an uptrend. We can see how they open on the lows and close on the high, open on the low, close on the high. Very small overlap, so the market's expanding away from price. Open on the open on the low, close on its high. And this is the same the bull trend on the 1 minute time frame. Open on the low, close on its high. Bull flag, open on the low, close on its high. These are all trending bars. And we can see some dojis within the pullback in the middle, right here. So it's a good way to see comparison. These dojis have a lot of tails, and these trend bars are trending away from their open. Here's an example of a downtrend. You can see the strong, an open with a strong close, open with a strong close, a pullback, and then the market trends lower. Same concepts apply. The open is high and the close is low. The open is high and the close is low. So the market is trending. It's looking for a new price, a small pullback. You see some dojis in the middle here. Open on its high, close on its low. Open on its high, close on its low. Open on its high, close on its low. This is a trending environment. These are the doji bars. You see how it's a big up and a big down. Excuse me. You can see how it's a big up and a big down. And in the middle we have indecision. So we have an open with a strong close, but then bulls bought the strong close and the market went a little bit lower. It came up and then it went up again. So the price stayed within the boundaries of these bars. But I just wanted to highlight the middle doji, how the price opens at the high, it came down and went up, and it closed on its low. Unfortunately, the black box is hiding this candle's wick. This wick would be around here. You can kind of see the close and the open. Bar basics, signal bars, entry bars, setups, and candle patterns. Signal and setup bars tell us when to enter in the markets. They only become signal and setup bars if the order gets filled on the bar after. This means a signal and setup bar are labeled in hindsight. There are two types of entries, with trend and counter trend entries. With trend entries go in the direction of the current trend, and counter trend entries go against the main trend. New traders should focus on with trend trades only. Enter with stop orders one tick above or below the signal bar. The order gets filled as the market makes a trend bar in the direction of the trade. Candle patterns are formed through price action and have no mystical value. New traders believe they can learn one pattern and they will become profitable. So this last sentence is actually really important. The candle pattern only makes sense if the context makes sense. Throughout the whole book, throughout the whole first chapter, Al is always following up with take the trade as long as the context makes sense. Context and then trade. Not trade and then does the context make sense. So here's just some examples of how he recommends beginners should order. There's a bull flag and a bear flag. Here we can see a strong push up, a two-legged pullback, and then there's a small bull flag within the major bull flag. If traders think the price will go higher, they should place a buy stop order above the signal bar, and it will get filled on the next bar over. Once the order gets filled, this becomes an entry bar, and this becomes a setup or signal bar. If the price happens to turn around and not take your order, then it doesn't become a setup or signal bar. Just cancel your order and wait for another trade. Same thing with the bear flag. We can see a bear flag, a strong breakout, and a small pullback. The market pulls back on this bull doji, and then it goes for a new low. When the market's going for new low, traders should place a stop order one tick below this doji, and it'll get filled on this bar over. This is the signal bar, and this is the entry bar. I would place the stop below this bar. That's why you see it over this wick, because this is also a strong bar, so it would still get filled here or on this doji. Signal bars, reversal bars. Reversal bars can be with trend or counter trend entries. All reversal bars should have a strong close with a minimal tail on top or bottom. This shows the market tries to move in one direction, then has a strong close in the opposite direction. They shouldn't be taken without analyzing the prior price action. Reversal bars and all trades will only work if the context makes sense. Beginners will look for reversals in strong trends. Instead, wait for a reversal bar in the trend direction. Counter trend trading should be avoided as a beginner. I want to talk about this sentence. Instead, wait for reversal bars in the trend direction. That took me a while to understand, so I want to show you guys because it's really important. So this is a bull and bear reversal. We can see a bull flag forming. Here's a double bottom. These two bars where my mouse is hovering over is actually a bear channel. So if we think the bear channel starts here and ends here, this actually becomes a reversal bar. They tried to go down and they forced their way up with a strong close. Bulls were buying up until the last tick. There's no wick up top. So this is a strong bull reversal bar in a bull trend. Same thing goes for the bear reversal. Here we see a bear flag and a pullback. The bulls tried to race up to break the market structure, but the bears rejected. It became a failed breakout reversal bar with a really strong close and a one tick at the end, if you guys can see that where my mouse is over. So this is a strong bear reversal with trend. It's a bear reversal and a bear flag. These are counter trend reversal bars. These are what traders should be avoiding until you understand how to read context better. It's always better to trade with the trend. Here's a bad bear reversal bar. We have a strong push up and then a reversal bar. The bulls try and make a new high, but bears slam them down and with a strong close and no wick. This looks like the previous bar on the bear flag. Here's a bad bull reversal bar. The bears try and go down on this wick, however the bulls buy up the tail, and they push high with a strong close and no wick at the top of this bar. So these are both the same bars I just showed in the previous slide, but with really bad context. And I'll show you, there's a comparison. So this is the first bull reversal, the good one. This is the bad bull reversal. We can see how these two bars look almost exactly the same. Wick at the bottom, strong close. Wick at the bottom, strong close. This is a with trend reversal, so it's a good buy. This is a bad with trend. This is a bad reversal. It's a counter trend reversal. You can see bulls got filled with this wick, but then they were immediately in the red. They had no time to get out, honestly. If you didn't scalp out one point, you'd just be in the red for two huge bear bars. It's not good. Same thing goes for the bear reversal. Here's the strong bear reversal. Bulls get trapped and then failed breakout. This becomes a continuation pattern. It's a reversal, but it's a continuation in a bear flag. Same exact thing with the bear bar. In the bull flag, here's that bear bar. They look very similar. In fact, this had a stronger close. There's no tick on this one. But it's within a bull flag, so it ends up being a trap. They didn't even break below the doji. That doji shows a range, and this is a trap. This is a bad bear reversal. It's a counter trend reversal. This is a good bear reversal going with the flag. Signal bars and other types. Every bar in theory can be a signal bar if the trader takes it. Not every signal bar will lead to a profitable trade. Only take the best signal bars that match the context. The context of the signal bar always comes before the way the signal bar looks. Think back to the previous two slides. The counter trend reversals looked great. They looked like the exact same thing you would take it with a with trend trade. However, they were really bad context and you would lose money. These are the other types of signal bars. We have an outside bar, a bar that goes below and above the previous bar's range, a bullish 2-bar reversal. The first bar is a bear bar, the second bar is a bull bar. Two 5-minute bars will create a reversal on a 10-minute time frame. Bearish 2-bar reversal. The first bar is a bull bar, the second bar is a bear bar. Two 5-minute bars will create a reversal on a 10-minute time frame. A shaved bar. A shaved bar is when there are no wicks on the top or bottom of the bar. This shows urgency in the direction of the trend. Bulls want no wicks up top. Bears want no wicks on the bottom. Strong closes. Exhaustion. This bar happens at the end of a trend and can race to the support or resistance level, usually bigger than all bars late in the trend. Signal bar is outside bar. An outside bar is a bar that goes below and above the previous bar's range. This is a bullish outside bar. If we look at this bar in the middle, the bears came down below and the bulls went up top. So the bears get filled at the lows and bulls get filled at the highs, and that creates a range bound environment. Outside bars can be range bound. So it went below the prior bar and above the prior bar. Here's a bearish outside bar. It goes above the prior bar and below the prior bar. Bulls get filled, bears get filled, and this becomes one big range. Bears can sell the highs, bulls can buy the lows. Here's a signal bar. Signal bar is bullish 2-bar reversal. Bullish 2-bar reversal. The first bar is a bear bar and the second bar is a bull bar. Two 5-minute bars will create a reversal bar on the 10-minute time frame. Here's the first bear bar. They try and go down, and then bulls buy up the bear bar and reverse right back to the highs. And on the 10-minute time frame, this looks like a reversal pattern. With the right context, this could be a good trade. With bad context, you could be buying the highs and shorting lows. Signal bars. Bearish 2-bar reversal. A bearish 2-bar reversal. The first bar is a bull bar. The second bar is a bear bar. Two 5-minute bars will create a reversal bar on the 10-minute time frame. Here we can see the bull bar, and then the bears reverse it and create new lower prices. Strong close with a small wick. On 10-minute time frame, this looks like a reversal bar. If we saw this at resistance, it could be a good short depending on what happens to the left. See how the market raced. This tail you guys see is this bull bar, and then this close you guys see is the leftover of the bear bar. So bears won the 10-minute battle here. They're in control of the markets within these 3 candles. Signal bars. Shaved bar. Shaved bar is when there are no wicks at the top and bottom of the bar. This shows us urgency in the direction of the trend. Bulls want no wicks up top, bears want no wicks on the bottom with strong closes. So look at this first candle. There's a wick. So this tail shows a failed breakout and then a rush by the bulls. No ticks up top, and it shows urgency. The market is willing to buy up until the last second of the candle close. These are all done on the 5-minute, by the way. Same thing for the bears. We see selling pressure pick up, and then there's wicks on the tails on all 3 of these candles. And then look at this candle that I'm pointing at with the arrow. No tick at the bottom. So bears are willing to sell up until the last second. They're selling, and then we see lower prices. Signal bars. Exhaustion. This bar happens at the end of a trend and can race to support or resistance, usually bigger than all bars late in the trend. So here we can see a pretty decent bar with the start of the breakout, and then we see some pullbacks and some overlap, and out of nowhere this bar raced to resistance. This bar is clearly bigger than all the bars to the left, and it happened faster. Since the market moves so fast, they can see this as a gift and people will take profits. This usually will stop at an important resistance level, which is why you see bears shorting. Bulls are taking profits, they're selling out their positions, and then bears are also selling. So this creates 2 types of people selling in one spot. Same thing for this bear flag. We can see a good bear bar starting the trend, and then we trend lower, a couple pullbacks, and then a nice bar at the end of a trend. These bars look identical, but it's still bigger than all the previous 10 bars. This bar also races down to support. You can see here bulls are taking profits and bears are taking profits and bulls are buying lows. These are signs of an exhaustion bar, and the trader should think about closing his position and waiting for a new setup. Outside bars. An outside bar is a big range on a smaller time frame. These bars can be confused for breakout bars, causing traders to buy the highs and short the lows. The stop is usually far away from the entry. For these reasons, outside bars can be traps. Outside bars can be great signal bars if the context makes sense. For the context to make sense, the bar should be coming from a reversal after a trendline break. I'll give outside bars its own section within chapter 1 because of how easily you can get trapped. It's really easy to lose money on a bad outside bar, and they look like breakout bars. So these are examples of good outside bars. You see a strong bear trend with a channel line break and a retest. This candle is retesting the lows and it fails. Bears try and short the lows, and bulls reverse the bar back into its high, and there's no ticks, so they're willing to buy up until the last close after a channel. after a bear channel. So this is showing the market could be transitioning within the range or a small pullback. This is a good bullish outside bar, taking out all the prior bars, highs and lows with a very strong close. This is a bearish outside bar. Here we can see the bulls trying to push higher and bears get the trend line break and they come up for a retest. The bearish outside bar goes a couple ticks above this doji, so the bulls are getting trapped, and then the bears force the bar down to its low. There's a small tick on this, but that's okay because we can see the context is good. We know bulls got trapped. The bulls bought above this candle and got trapped on this doji, and they try and buy more and got trapped again, and the bears slammed the price down. So bulls who bought this candle are underwater, and we can see it led to lower prices. So this is a good outside bar. This is outside bars with bad context. There's no channel line break. It's just that the markets are going sideways. And since the markets are going sideways, bulls bought this candle, so they're buying the lows, and bears are selling the highs. If you're a bull who thought this was a good breakout of the previous candle and you bought the high, you would be trapped. If you're a bear who shorted the lows, you get short here, you get trapped going up. These are bad context, bullish outside bars. This is a bearish outside bar with the same exact idea. The market is sideways, the price is not expanding. Remember, we know what trending candles look like. This looks like a lot of overlap. It's not good. Bulls get filled by one tick and bears get filled by one tick here, trapping traders on this bar and this bar. If the bear was to go short here, he would put his stop up here and immediately the market would reverse. If the bull was to go along here, he would put his stop down here, get filled, and the market would immediately reverse. For these reasons, bad outside bars can be traps, and it's really important to make sure you have a trend channel line break. The importance of the close of the bar. It's important to wait for the bar to close before entering because the close can tell us a lot of information. Traders like to front run a breakout in the final seconds of the close to gain a few extra ticks, then the bar suddenly collapses and it becomes a failed breakout setup. The speed of this happening is often too fast for the trader to flip to the right direction. This does two things. The trader wanted to make a few extra ticks, now she is in a losing position, and the trader misses a good entry for a winning position. The few extra ticks the trader was trying to make was not worth it. I don't have any slides for this one because there's a small section of Al Brooks explaining this. Please wait for the candle to close because the 5-minute candles can collapse at the last second and you'd be buying the highs or shorting the lows of a failed breakout. Exchange traded funds and inverse charts. Sometimes looking at an ETF could help clear up price action. SPY is almost identical to the E-mini. If you are having problems reading the chart in front of you, sometimes an inverse chart can help paint a better picture. We all know what SPY is. It's an ETF. Sometimes the price action is clearer on one ticker than it is the other ticker. I think SPX is also the same. So stick to the one you trade, stick to the one your broker lets you execute on. If you're having problems reading inverse charts, sometimes you can inverse it. I tend to be more bullish, so if I was having problems reading a bearish day, I could decide to inverse the chart and help me see things from a bullish perspective. And this is an inverse bullish chart. These arrows are pointing to the pivots, so you can see it's the same chart. One looks like a bull trend, one looks like a bear trend, but there's the same exact price action flipped. Second entries. Second entries are better entries because it shows the market has failed to go in one direction twice. If a second entry comes at a better price, this could be a trap. Second entry should have a worse fill because we are waiting for information. This is really cool and it's helped me save a lot of money and find better trades. This is a bull flag, a good second entry, and a bad second entry. Here we see the first pullback creating a high one. This is the first entry, and then another pullback and a high two. This creates the second entry. What this is doing is showing that the bears failed to break out once, came up, and failed to break out twice. This is causing a trap and a break of the bear channel. This is a good buy. This is a bad buy. This is still a bull flag, but you can see the high one is up here, and then a deep pullback and a high two. You might think, oh, this is a range play and I should buy the high of this because this is a great bar. It's a shaved top, no wicks at top. This is what we just talked about in previous slides. However, The difference between these two is there's no trend channel line break. We're still in this broad bear channel after a bull trend. This is more of a range play. You see how buying this high, if you hit in, you would get trapped into a losing position. If you hit in here after a new high is made a higher low, this would be a winning position. This is a good one. This is a trap. The bears get trapped, failing to break out. Here, the breakout for the bears is still going, and this is actually just a pullback in a bear trend. Leg 1, leg 2 for the bears. Second entries, the bearish. Good second entry we can see is a double top bear flag. This one's a little bit hard to see, but if we entered on this bar, we would get an alright price, and we'd have to wait for more. We'd have to wait for the pullback. The second entry comes at a worse price with more information. 2-bar reversal, small wicks led to another move down. If we enter here, it's a worse fill, so the entry is worse. This is a better entry, but we're paying for the information. Bad second entry. Strong bull bar. You try and go short here. Bulls make another leg up. You try and go again. Look, you can short at a better price because this bar is higher than that bar, so this might actually be a bull trend. You can see a double bottom and a flag. This ended up being a bull flag. So what it means if the second entry is a better price, this second entry is higher than this, so you can make a few extra points. So that's a better price. This second entry is worse. It's lower than this, so it's a worse price, and we have more information. Now we know the double top, we have 2-bar reversal. Same thing here. This is a worse priced. So if you enter here, you're going to lose points because this is a lower price bar entry. This is a good entry theoretically because you're saving what you could buy lower. But since you're buying lower, later you're actually buying into a bear leg. You have more information. Why would you get more information and a better price? Late and missed entries. When we are trading a trend, it is easy to miss an entry. If a trader needs to take a missed or late entry, he should enter at the market with partial position size or the correct stop while using the correct stop. Al uses a rule of thumb to enter in 20% of your position size. 1 E-mini contract is 10 micros. 2 micros contracts is 20% of 1 E-mini contract. So what this means is if you wanted to enter late in a trend and you're seeing the market's racing away, get in the trend with 20% of your position and put the stop where it's supposed to be. Trail it how you would with 20%. Scale in, scale out. If you were to enter 1 E-mini while the market has ran, your stop may be 10, 15 points. That could be a $500-$600 loss just on one contract. It's not worth it for a few points. So Al recommends to enter 2 micros because that's 20% of 1 E-mini contract. 1 E-mini contract is 10 micros. This is the end of chapter 1. Please leave any questions in the comments and I'll try my best to answer them. Thank you for your time, and if you learned anything, please consider hitting the subscribe button. Have a good day, everyone.